IDFC First Bank has, as always, shown a strong 21% growth in advances and a 25.5% growth in deposits. But profit is down 32% from year-ago levels due to a higher 24 basis point fall in net interest margins. That is a QOQ comparison. Margins have fallen to 5.71%. There has also been a rise in provisions for bad loans, or what you call credit cost. That's risen by 22 basis points compared to the quarter ago. It's risen to 2.78% of total loans. What is important is the defaults in microfinance loans have fallen, but defaults in non-microfinance loans appear to have risen. Joining me to give us more colour on the results is the Managing Director and CEO, Mr. V. Vaidyanathan. Good morning, Mr. Vaidyanathan. Thank you very much indeed for joining us. Many congratulations for keeping the tempo on advances and deposits. But the concerns, I'm asking the concerns first. The rise in credit cost or rise in slippages, it is not microfinance. Where is it then?
So if you see the overall number, Latha, the microfinance has come down as you put it. But the overall percentage of credit cost, about 2.5%, is more because of the fact that composition is still microfinance, like 500 crores out of that is microfinance. So on the rest of the microfinance book, nothing to specifically to call out. You've seen the numbers that have come from the system as a whole. Slippages in the system have actually risen during the last quarter. You've seen results of all companies. I think it's a bit seasonal and, of course, a little bit of microfinance. But the SMA data, which is the feeder data to the NPA or slippages, SMA, that number has actually come down. Last quarter was 1.07. This quarter was 1.01. So we feel the feeder bucket into the slippage will improve in the coming forward. Going forward.
Fair point. A fair point. Just for those who don't like abbreviations, SMA1 and SMA2 refers to loans. Borrowers who haven't paid for 30 days and people who have not paid for 60 days. And that, Mr. Vaidyanathan points out, has fallen by 7 basis points in Q1. And therefore, the feeding into NPAs should perhaps fall. But what is the cause of the slippages, sir? Is it unsecured loans? Where exactly is the trouble? Is it MSME? Where is it?
I know. There are numbers. There are different numbers coming from the system from different players. Someone talked about commercial vehicles, someone talked about MSME, someone talked about something. But for us, it's a little more broad-based that has come. But also, Latha, the main thing to note is also as a slippage, a percentage sense. In absolute terms, also, in percentage sense, is also relatively higher for our bank vis-a-vis the system, generally speaking. Also because we do inclusive banking, we do more, if everybody in the country were to give home loans and car loans, really, you need banks like ours also who are doing a little more inclusive banking, where the margins also make up for it. If you can see a net interest margin like 5.7% is pretty strong. So as the bank evolves into the next 4-5 years, we'll keep aligning more into the mainstream banking system.
Okay. No, I take your point. Actually, that also intrigued me. And you spoke about this in our previous interviews also. So can we say, how will your NIMs trend? At the moment, we have seen this 24 basis point quarter-on-quarter fall. What may be your exit NIMs, Q4, for instance?
So let's talk immediate next quarter so that people get a full clarity. So as you know, this quarter, for example, the deposits yet have not repriced. It takes 1 year to reprice. But, the repo has cut and yields have come down. So this quarter has come down to 24 basis points. We expect next quarter for it to dip further because the next 50 basis points yet to be passed on. So think that a margin will be even lesser next quarter. But nothing to worry. That's the cycle. By Q3, we expect them to go up again. By Q4, we expect them to come back to about 5.85 plus. So think of it like a dip, and Q3, Q4 will take off from there.
Okay, because but this quarter, Q2, your margins can fall another 24, you think, because of this giant rate cut?
I can't say 24, but I don't know, maybe like 20 odd. I don't know, I can't put a number to it. But it's coming down for sure, so people should take note of it. But I tell you, it's a cycle. By Q4, will be back up because, Latha, one really good thing we have done, we talked about deposits earlier in a very short way. But the deposits of the bank, we have built such a good franchise that we're able to cut deposit rates sharply. Last quarter, maybe a quarter ago, we cut the fixed deposit rates straight from 7.8% on the peak rate to straight to 6.75 in line with the big banks. So that is a big cut, like 115 basis points. And as you know, fixed deposit is 50% of our funding. So that will give a material development to the bank by Q4 of this year.
Okay, fair point. Can you just dwell a little more on the credit cost as well? There are some areas where you have seen higher slippages. What are those areas, and how may they pan out by the year end?
So by the year, we think that by Q3, Q4, of course, because microfinance issue will be maybe gone by the time. So the credit cost by Q3, Q4 should be lesser. So like H2, definitely we feel lesser credit cost than the first half. And first half, we said, you talked of many banks, we all talked about seasonality, etc. So H2, progressively, let me say that credit cost as a percentage of average book should continue to come down. And average for the year, we are in the zone like 2.05% we talk about, which is about 1.3% of assets. Okay. We feel that's comfortable, actually. It will come down. You should watch this quarter after quarter. You will feel that you will see it will come down. And certainly,
but is this unsecured loan, or was it any one corporate loan? I thought you said that there was a toll collector which also pushed up the bad loans.
I don't want to keep calling out one-timers because this is part of business. But to specifically, since you asked, I'll just tell you that there was one ATM company that went down in the last maybe 5-6 months. We had 110 crore exposure to that company. We took it all off in this quarter in the P&L.
Okay. What will be the growth drivers in the next couple of years, or even later this year?
Like we said, we have to align with the systems. Let me just tell you, what are we doing to align with the system? So, because we can't forever be a high yield and high OPEX and high credit cost bank. It's an early stage, right? Eventually, we have to align. So how are we doing that? So we are growing 4 lines of businesses, Latha, which will make it up, actually. One is mortgages coming up. If you see this quarter also, this year YOY growth is 43,000 crores. Of the 43,000 crores, 8,000 crores came from growing mortgages, like home loans and property loans, etc. The second big growth came from business financing, business banking, basically working capital financing for small entrepreneurs. We take properties collateral. That's about 8,000 odd crores, and along with other business financing. The third thing that is growing is vehicle financing. That grew by 5,200 crores. The fourth thing that grew was corporate banking. That grew by about 14,000 crores. So if you add all of these up, that makes about 85% of the total growth. We like these businesses, and when we align with the system, I guess we'll have to keep growing these. We'll also grow gold loans. So we'll build these businesses in the next 4-5 years. You'll see the yield also will come down. Credit cost also will come down. OPEX also will come down. We're aligning with the system. That's the phase of the bank.
Fair point. Actually, it looks like you have convinced the market a great deal by this interview. And in the last hour, your stock has gone up by 1%, overall up 0.7% after these numbers. Thank you very much, Mr. Vaidyanathan, for spending time with us.